Hello students, my name is Teher Sheikh and today we are going to start bookkeeping and accountancy for standard 12th. Your first chapter of this subject is Introduction to Partnership and Partnership Final Accounts. So as you can see from the name itself, the chapter is divided into two parts. The first part is Introduction to Partnership, wherein we will learn what is a partnership, and the second part says Partnership Final Accounts, in which we will learn to maintain the books of accounts of a partnership firm. So the first concept which we are going to learn is meaning. Partnership is an organization where there is an association of two or more persons coming together to carry on business with a view to share profits or losses of a firm. So, as we can see that there are two or more individuals coming together and they will share their profits and their losses. This will increase their capital and reduce the risk involved in business. The second concept is the definition of partnership, which is to be learnt by you. It cannot be altered. So, the Indian Partnership Act 1932, Section 4 defines the partnership as it is a relationship between persons who have agreed to share the profits of a business carried on by all or any one of them acting for all. So here people will form a relationship. They will agree to share the profits of the business. They will either carry the business by all of them, or they will assign this business to one person who will manage the business by himself, and others will share only the profits and the losses. They will not be involved in the next concept which we will start is features of partnership firm. The first feature is agreement. Partnership is a result of agreement between partners. That is, when two or more people come together, they agree that they will share the profits and losses of a business, this type of business activity they will follow, etc. So, the agreement can be written or oral. A written agreement is called a partnership deed, which is a proof in the court of law, and it is very helpful to all partners. The second one is number of partners. Minimum number of partners to form a partnership firm is 2 and maximum is 50 according to the Companies Act 2013, but now it is amended to 2014. Lawful business is the third point. You can form a partnership only for lawful businesses which are permitted by Indian law. You cannot carry out illegal activities and form a partnership for it. Fourth point is sharing of profits and losses. The partnership is formed for sharing profits, but in case of losses, all the partners have to share the losses and profits, if there are any, in the ratio given in the agreement. If the written agreement, that is the partnership deed, does not provide the ratio in which the profits and losses are to be divided, then the partners will share them equally. Unlimited liability. The liabilities of partners is unlimited, joint and several. That is, partners are liable till the last rupee in their pocket. If the assets of business is not sufficient to pay liabilities, then personal property of partners can be used. That is, if the business is suffering a loss, then A, B and C, if they are partners, they are liable for all these losses. They cannot limit their share to only the business capital which they have contributed or the assets which they have contributed in the partnership. They will be liable to pay for the losses till the last rupee in their pockets. If any one of the partner is declared insolvent, that is, if he does not have any money with him, he is declared bankrupt, then his liability will be borne by the solvent partner who has money with him. So, in short, all the losses will be compensated by the partners, and if one partner does not have enough money, others will contribute his losses. The sixth point is registration. So, every partnership firm has to compulsorily register in the state of Maharashtra, and you cannot carry on business without registration. Joint ownership and management. Each partner is a joint owner of the property of firm. They cannot say that I have a computer in the name of the firm. I will use this computer for my own purpose. No, they cannot use it for personal purpose. It only has to be used for partnership purpose or the purpose for the business of partnership. All partners are jointly responsible for the management of firm. They have equal rights in managing the firm. Eighth point is principal and agent. Each partner has a dual role, that is, he is principal and also an agent at the same time. When he acts with outsiders of the firm, he is the principal of the firm. But if he acts with the partners of the same firm, then he acts as an agent. Dissolution. Dissolution means to dissolve the partnership. A partnership can be dissolved through agreement with partners. It has to be dissolved giving a 14-day notice. That is, closing down of the business of partnership can be done by giving a 14-day notice. So here we have completed all the features of partnership firm. The next concept which we are going to start is partnership deed. The written agreement between the partners is called a partnership deed. It is not compulsory to make a partnership deed, that is a written agreement, but it is very beneficial in case of dispute or where there is losses and people do not know how much losses they have to bear. So the partnership agreement will specify the ratio in which there is a distribution of profits and losses. So it contains all the terms and conditions which are pre-decided by the partners, and it serves as a tool for the rules and regulations framed for the internal management of the firm. So now, as you can see, this is a pro forma or a photo of a partnership deed between the partners. It has many parts. The contents of partnership deed are name and address of the firm and its main business. Where is the firm located? What is its name? And what is the business of the firm will be written in this deed. Name and address of all partners and duration of partnership. The details of all the partners will be written. For how many years or months will the partnership continue to be enforced will be written in this deed. Capital contribution of partners. How much money each partner has brought in to the business of the firm will be written in this partnership deed. Ratio in which profits and losses are to be shared. In case of profits or losses, how much each partner will get from it will be specified clearly in the partnership deed. Rights, duties and liabilities of partners. So here, what are the rights of partners? What they will receive from the partnership firm? What are their duties? What they have to do towards the achievement of goals of the partnership firm? And what are the liabilities of the firm that the partners have to bear will be written in this deed. Provisions related to admission, retirement, death, etc. of a partner. When a partner needs to be admitted into the firm, or in case of death of a partner, how will the firm proceed further, or what will be the procedure adopted for doing things in future will be written in the partnership deed. Rate of interest on capital, loans and drawings. This is a very important aspect as interest on capital is important and the partners earn it, so they will be very keen to know how much the partnership will pay them interest. Interest on loan is an income for the partnership firm, so the partnership firm will define what is the percentage which it will charge on the loan given to the partners. Interest on drawings. When the partners draw money from the business, the partnership firm will charge interest on the same. So it is a type of income for the partnership firm. So the partnership firm will clearly specify that this is the percentage of interest the partners have to pay in case of interest on drawings. Salaries, commission, etc. if payable to any partner. For example, A is a partner. He is fully managing the business of the firm. Then A will be paid such amount of salary, example 20,000 rupees per month. So this will also be specified in the deed. Settlement of accounts on dissolution of firm. The accounts of partnership firm will be settled in a manner provided by the partnership deed in case of dissolution, that is closing down of business of the firm. Method of settlement of disputes among partners. The partnership deed will also specify the method of settlement in case there is a dispute between the partners of the partnership firm. Any other matter relating to the conduct of business. In case of a business, what other matters will be included in the partnership deed, the partners will discuss and include in the deed itself beforehand, so that there are no confusion and no disputes regarding the same in future. Importance of partnership deed. It is a very important document because 1. It is written agreement, 2. It can be used as a proof in the court of law, it lays down terms and conditions of the partnership, and also it helps to regulate the rights, duties and liabilities of all the partners of the firm. It has to be duly signed by all partners. So now, the next concept which we are going to study is provisions of Indian Partnership Act. These are the very important provisions which the Act states, and these have to be remembered by you. The first one is distribution of profits. In case the written deed which is agreed between the partners is silent about the distribution of profits, then profits will be distributed equally. Interest on drawings. If the date of drawing is not given, then average of 6 months interest is charged on drawings. Interest on partner's loan. If the partner provides additional amount to the business as loan, but rate of interest on loan is not given in the partnership deed, then 6% interest is allowed. Interest on capital. If the partnership deed is silent about interest on capital, then interest is not allowed. Salary or commission to partners. As per the provision made in the Indian Partnership Act 1932, no salary, commission, allowance or any remuneration is to be given to any partners for any extra work done for the firm. However, if any provision is made in the partnership deed, that is, the partnership deed states such a provision, then and only then the partners are entitled to get commission or salary as per the agreement. Admission of a new partner. As per the provisions of Indian Partnership Act 1932, no outside person can be admitted into the firm as a partner without the consent of other partners. That is, if A, B and C want to admit a new partner D, they have to take consent of all the partners. As you can now see, the next concept is methods of capital account. There are two methods of maintaining the capital account. One is fixed capital method and second is fluctuating capital method. In the first method, two accounts are prepared. One is the capital account of partners and one is the current account of partners. In the second method, only the capital account is maintained. So the main difference between these two methods is that the first one has two accounts of the partners, one being the capital account in which there are no adjustments to be made, it is fixed in nature, and the second account, which is the current account, contains all the adjustment entries which the partner has entered during the course of the year. The second method states fluctuating capital method. In fluctuating capital method, only one capital account is maintained per partner and all the transactions which the partner does are reflected into that single account.